This video deals with bad debts deductions and also the provision for doubtful debts. You'll note with provision for doubtful debts that the rule has changed since 2019 and the old way that they used to use no longer applies. So for some students, this may actually be something new. Bad debts has not changed though. Let's look at the requirements for bad debts. The requirements are debts must be due to the taxpayer. So if it's not your debt, you can't claim a bad debt deduction. Debts must have been included in the taxpayer's income for the current or previous year of assessment. Can't get a deduction if it wasn't income for you. Debts must be proved to the commissioner's satisfaction to be bad. So there must be a bad debt. And then debts must have during the year of assessment become bad. So you've got to claim it in the year that it becomes bad. If you forget to claim for something, you can't claim it in a later year. So again, you don't need to learn this off by heart. Again, if you go to your cycle legislation handbooks and you want to tag, you can just tag. So it says any debt due to the taxpayer during the year of assessment becomes bad, provided such amount is included in the current year of assessment or was included in the previous year of assessment. So all of the requirements are there, and you can do it off there. So you don't need to learn stuff off by heart. Having a look at the examples. Oh, one more point. It says it should be noted that if there's a compromise reached between a debtor and a person who money is owed to, this will not constitute a bad debt. So if you agree to actually reduce someone's debt and the person is not financially in a dwang, then you can not claim it as a bad debt. The person can afford to pay you. If the person is on the point of liquidation and that is agreed upon to actually reduce the debt there, you can claim it as a bad debt if the person could not possibly pay you back. So, illustration 5A. A Limited sells trading stock for 2 million. During the current year, 250 of the bad debt has become bad. Will a deduction be allowed? Is it due to the taxpayer? Yes. Was it included in your income for a previous year of assessment or the current year? Yes. Bad debt to the commissioner's satisfaction? Yes. Did they go bad during this year? Yes. Therefore, if you ever get a discussion question for discussing a bad debt deduction, this is how you should approach it. 5B. A Limited sell their office building for 2 million. During the current year, 250,000 of that debt has become a bad debt. Will an amount be included in terms of section 11I? So guys, was it due to the taxpayer? Yes. Were they included in the taxpayer's income in the current or previous year of assessment? Now guys, as far as this one's concerned, sorry, guys, this is a capital transaction that was never included into gross income. Capital requirement 2 not met. Therefore, this would be a capital loss. So your proceeds would be null. The base cost of your debt would be 250 and you'd be able to claim a capital loss of 250. It's very important to realize that if you can't claim a bad debt deduction, you can claim a capital loss with a transaction. Next one. It says A Limited give staff loan to an employee. The capital portion of the loan is 10,000 and interest of 2,000 has been charged on the loan. The company disappears and the company decides to write off the loan. Can a deduction be claimed? Now guys, the loan of 10,000 was never included in income. Therefore, it cannot be allowed as a bad debt because one of the requirements is missing. But the 2,000 Rand interest was included in gross income, therefore you can claim it as a bad debt. So this would be an example where part of it is claimable and the other part is not claimable. So no deduction can be claimed for the capital portion of the loan as it was never included in gross income. And down here, you can claim a capital loss of 10,000. Proceeds 0, base cost 10,000, loss 10. The interest portion of the loan is deductible as it was included in the gross income of the company itself. Guys, next one. L Limited is approached by B Limited who owes 10,000. L Limited agrees that in order to retain B Limited as a client, B Limited need only pay 7,000. Now guys, as far as this is concerned, this is not a bad debt. They can afford to pay you. Therefore, you're not going to get a bad debts deduction. But what can happen, guys, is you can get a capital loss of 3,000 on the debt that's been reduced. Coming back now. Illustration 5e. B Limited owed 1,000. B Limited went insolvent on 2 Feb 20X09. On 18 April 20X09, the liquidator said there was no prospect of money being received. Year end 30 June 20X10. So in the previous year, they couldn't get the money. A Limited did not claim for the amount in year 1 due to a mistake. One of the requirements is it needs to go bad in the year of assessment. If you forget to claim, you simply cannot claim. Mr. C owed 1,500 Rand. He bought the goods on 30 May. Company tried to trace him unsuccessfully and on 1 August gave up hope. 1 August you give up hope. Is that in this current tax year? Yes. Therefore, it is deductible. F Limited owes 5,000. F is still trading, but A Limited believe he's going to go insolvent in the near future. To this extent, they've stopped supplying F Limited. That's not a bad debts deduction because they think he might go insolvent. They're not certain. So it's not a bad debt yet. So what's going to happen with that? You're not going to be able to get a deduction. So just let me, sorry. So no bad debt may be claimed as it's not yet bad. Next one. A Limited bought the debtors book of Mr. D. They could not collect 2,000 worth of debts from his debtors book. It was never included into your own gross income. Therefore, no bad debt can be claimed. However, if this is trading stock, by the way, and you trade in debtors books, you could actually get a trading stock. You could get deductions through trading stock. But in this case, it wasn't included in your income. Therefore, you cannot claim a bad debt. 5. A Limited lent money to G Limited, a supplier of theirs. They knew that G Limited was in financial difficulty but needed to ensure that they continued to receive goods. G Limited went insolvent during the year and 2,000 was still owing. So just again, guys, it was never included into your income. Therefore, you cannot get a deduction under 11I. But why did you lend us? So that you could ensure continuity of supply. You could claim this under 11A, general deduction formula. So what I'd like you to do now is please turn to the teaching example. There's a bad debts section here. You don't need to do all of it. I just need you to do it up to here. So please try to do those 4 examples and then we'll mark them before going on to provision for bad debts. So let's go through this. 110,000 written off as bad debtors, as trade debtors for the year. Of course, you can claim them as a deduction. When your own trade debtors don't pay you, you can claim a deduction of them, providing you claim them in the correct year. 60,000 written off trade debtors for last year. The amount should have been claimed last year, but the company forgot to. If you don't claim it in the year that it occurred, you don't get a deduction. Therefore, not deductible. Next one. Staff loans of 4,900, 900 interest added to the 4,000 original debt. The 900 interest is deductible because it was included in income. The 4,000 Rand staff loan is not deductible, but you do get a capital loss. As you can see this, 4,000. And in the previous example for the bad debt, you forgot to claim the capital loss. Both of them are allowed as capital losses. And the last one, the company compromised with the debtor. The debtor only paid 8,000 of a 10,000 debt. The debtor could not afford to pay everything, but agreed to use the company as a sole supplier in the future. Right? Compromise of debt. The guy can afford to pay you. Not allowed as a bad debt deduction, but you can claim it as a capital loss itself. So that is bad debts.